Good morning, everybody. The June 16, 2020 School Land Board meeting will now come to order. Pursuant to the Governor's executive order to avoid gatherings of more than 10 and the Governor's March 16, 2020 suspension of certain provisions of the Texas Open Meeting Act, the June 16, 2020 meeting of the School Land Board is held today by video conference call as authorized under the Texas Government Code, Section 551, TAC 125. Access to the meeting by members of the public was published in advance in the Texas Register in accordance with the Texas Open Meetings Act. Any member of the public who wishes to address the SLB on a matter within the authority of this board should indicate so at the start of meeting or during public comment period. The chairman, which is me, I can limit time that is spoken available to each individual. I believe Corey will handle all Q&A to allow for folks that want to speak on a given issue before us today. First item on the agenda is approval of the minutes from the May 19, 2020 School Land Board meeting. After the board has had a chance to review and assuming no questions or comments, could entertain a motion to confirm the minutes for the record.
As presented. Second.
Motion is made, seconded, and carried unanimously to approve the minutes. Next item on the agenda is approval of the consent agenda. After the board has had a chance to review the consent agenda and its participants and activities, and assuming no questions, comments, or objections at this time, I can entertain a motion to approve. Any questions or comments from the board on the consent agenda?
None here. I'll move.
Second.
Motion is made, seconded, and carries unanimously to approve the consent agenda as posted. Items 3 through 6 are going to be held in executive session. We'll enter into executive session pursuant to Chapter 551, Subchapter D, Section 551, Tech 071 of the Government Code for discussion consideration regarding contemplated litigation or settlement offers, and subsection 551 Tech 072 for discussion consideration concerning purchase, sale, exchange, lease, or value of real property related to items 3 through 6. Following executive session, we will reconvene in open session to complete the docket. I'm going to advise for our visitors or participants to stay on the Zoom call. Corey will administer that room. Board members will return to the Zoom call following our phone conference executive session.
Commissioner, I have a gentleman. Yes. I have a gentleman wishing to make a statement on item number 3. Would you like to hear that before or after executive session?
Council, what's your recommendation on that?
Well, it's your option, Commissioner. We won't vote on anything in executive session, of course, so you could hear public comment after the executive session in the open meeting before any vote is taken.
Why don't we just go ahead and hear, I believe it's the legal representative from Pearl Resources.
Yes, sir, it is. Mr. Miller, I'll promote him to panelist now. Mr. Miller, you've been promoted to panelist. You should be able to be seen and heard now at your discretion using the controls on your screen.
Just a minute. All right. Can anybody hear me?
Yes.
Yes, sir.
All right. My name is Dan Miller. Hang on a minute. I'm hearing an echo. Should I get off my call?
Yes.
On the video?
Yes, sir.
All right. Let me do that. All right. Can you hear me still?
Yep.
Yes.
Okay. My name is Dan Miller. I haven't appeared before the board in time, but much of the legal staff and the staff members in the DLO know me. I used to work in the GLO way back in the 80s, and I ran the legal division. I'm here representing Pearl, their application for a suspension which covers, the lease itself covers 2 non-contiguous tracts in Pecos County, Section 20 and the south half of Section 22. Neither tract is near a public road. In fact, the nearest public road is about 1.5 miles to the west of Section 20 and about 2.5 miles west of Section 22. The only other public road is 4 miles to the south. Starting back, the lease that issued a bunch of undivided interest leases that the predecessor to Pearl began taking back in September of 2011, and they have a 5-year term. Back in 2014, Pearl began having problems getting access to Section 22 and was denied access by 2 different adjacent surface owners. First, on March 1, 2014, Gaynor Brandenburg, to be the son of the surface owner and the state's agent on Section 20, blocked Pearl's access gate on the east side of Section 22, that road going in there, and he put a large tractor trailer in front of Pearl's fence or gate. Pearl did file a legal action against Gaynor Brandenburg to force him to remove the trailer rig, but he was unable to convince the court to order it. Then later, in 2016, Roger Harris, who was an owner of Section 21 that sits right between Section 20 and 22, refused to agree to an easement across Section 21 to allow Pearl to get a rig into Section 22. Pearl was forced to file a condemnation action under the Natural Resources Code sections 11.079 to get that easement. And that was finally granted by the court on February 18th, 2018. I believe these facts are disputed by the GLO staff. In fact, the GLO staff was made aware of these facts about the time that they happened. Pearl verbally reported Gaynor Brandenburg's installation of the trailer rig blocking Pearl's access to Section 22. Pearl reported that to Drew Reed, a member of the staff of the GLO, back in 2014. Later, in 2016, in August, as a matter of fact, August 24th of 2016, Pearl reported that they were continuing to be denied access and that they were going to have to file a condemnation action. Pearl asked Drew Reed if the GLO needed any legal documents regarding the condemnation, and Drew just provided a daily report. All of this happened before the expiration of the primary term of any of the leases and before the lease expired. Reed did not tell Pearl that it needed to apply for suspension, despite the fact that Drew Reed had all the facts that indicated the basis for a suspension existed. So Pearl did not apply for a suspension at that time and went forward with its condemnation action. In my years when I was running the legal division, and even since, working with the GLO staff, I have found that in most instances, the GLO staff is very helpful to its lessees when they're confronted with problems like Pearl faces in this situation or faced back between 2014 and 2018. And the GLO does that for a good reason, because generally they view the state's lessees as partners in developing the state's minerals and producing royalty revenue for the permanent school fund. That, in my experience, including the lessees, letting the lessees know they've been denied access after trying in good faith to get it, they should get a suspension to stop the primary term from running while they're being denied access. And in most instances, I would have expected the staff to let Pearl know that and to offer them that opportunity. But that didn't happen. Despite the fact that Drew Reed expressly knew and understood before the primary term had expired that Pearl was being denied access and was being forced to file a condemnation action to get the easement they needed so they could get a rig to Section 22. So why did that happen? I don't know. But it's inequitable, to say the least, to leave Pearl without any assistance while Pearl was forced to fight the son of the state's agent who owes the state a fiduciary duty. And then Pearl was then forced to file a condemnation action with all the attendant legal fees and lost time to get an easement to Section 22 so it could bring in a rig. The staff sent us a letter saying that they won't recommend this suspension. In effect, saying that they don't think they have the authority to consider and grant it, or they do, because the Section 22 lease has terminated, or the lease as it covers Section 22 has terminated. And they say they don't have any authority, the staff does, to revive or re-grant the lease on Section 22. I disagree with that. We're not asking school and board to revive or grant the lease on Section 22 because it never actually terminated. Why didn't it terminate? Because the primary term of the lease was tolled or suspended due to the fact that Pearl was unable to access Section 22 between March 1 of 2014 and February 28th of 2018. Under the Natural Resources Code and the Texas Administrative Code, denial of access is grounds for a suspension of the running of the primary term of the lease. These suspension provisions, at least implicitly, recognize the common law doctrine of impracticability of performance. And what that means is, under law, the duty or the obligation to perform under a contract is suspended while the performance is rendered impossible or impracticable by the actions of some other person. That's precisely what happened here to Pearl. The oil and gas lease is a conveyance with two parties: the state, acting through its surface owners on Section 20, and Pearl. The staff of the GLO has determined on its own unilaterally that in this instance, the lease, at least as it covers Section 22, has terminated. But that's just one party to the contract. And a unilateral determination by one party to a contract doesn't make it so. In the absence of Pearl's agreement, our position would be that only a judicial declaration that the lease is terminated is binding on or on this board. So this board has granted suspensions similar ways before and done so retroactively. Most recently, it did so in June of 2019 when the GLO staff recommended and this board approved a suspension request by Siltstone Resources. That covered 4 different state leases: MF 11-832, 34, 37, and 38. And in that case, it was just on the basis that the surface owner had attempted to negotiate with the surface owner to get some access routes, and those negotiations were not successful. But in that instance, the board granted a suspension. In this instance, Pearl was denied access from both sides of Section 22 and was prevented from getting a rig to 2 proposed well locations that had been staked on Section 22. Pearl made a good faith and diligent effort to overcome that denial of access, and those facts were reported to the GLO staff, specifically Drew Reed, before the expiration of the primary term. In our view, it would be inequitable to refuse to grant this suspension request when other state lessees who have also been denied access have been granted suspensions. Accordingly, we're asking the School Land Board to approve this suspension request and suspend the running of the primary term of the lease as it covers Section 22 for the period March 1, 2014, when access was first blocked, through February 28, 2018, when the judgment was entered awarding an easement across Section 21. Thank you.
You're on mute, Commissioner.
I'm sorry about that. I was on mute. Thank you, Mr. Miller, for your synopsis. It will definitely
Did you hear any of that?
close consideration. Oh, absolutely. No, I just
Hello?
muted myself, so I didn't want to be part of your background noise. No, we heard it all. Everybody, all the panelists, the entire board did as well. We thank you for your presentation, for your time. I've already invoked the language to enter into executive session. and your consideration will be duly considered in the coming minutes. So thank you for your time, and I'm going to ask the board to enter into executive session.
Again, the board is coming back from executive session now. If you'd like to make a comment before the board, please use the Q&A feature, and I'll enable your audio at the appropriate time. Thank you.
The open session of the June 16, 2020 School Land Board meeting will now resume with item number 3.
Corey, can you open up Larry's mic, please?
He should be enabled. Larry, you should be good to go.
Good morning. Can you hear me now?
It's a little choppy. Give us another try.
How about now? Any better?
Much better.
Okay. So good morning. I'm Larry Hargrave, attorney with the Oil and Gas and Energy section of the Office of General Counsel. Item number 3 is the consideration and possible action on Pearl Resources application for suspension of state lease mineral file 113115, Pecos County, Texas, due to alleged denial of access. Staff recommends that the board deny the application as discussed in executive session. I'm available for any questions.
Any questions from the board at this time? Or a motion to accept staff's recommendation to deny the application?
I'll second.
All those in favor of the motion, say aye.
Aye.
Aye. All those against, say nay. Motion is made, seconded, and carries unanimously to approve item number 3, to deny the application. Next item in the agenda is number 4. I believe Susan was to present this issue.
Susan, you're in the meeting. You may need to unmute.
Susan, are you there?
I can see her. It shows that she's muted, and I'm not able to unmute her either.
This is Russell May with Asset Management. I can make the recommendation if you prefer at this point.
Go ahead, Russell.
Go ahead.
Okay. Staff is recommending the approval of disposition PSF land under the attached terms and exhibits as presented and being in the best interest of the state and the PSF. Can I answer any questions regarding that? Staff is making a recommendation on the disposition.
Any questions from the board? Is there a motion to approve staff recommendation?
I'll move. Second.
Motion is made, seconded, and carries unanimously to approve item number 4. Thank you, Russell. Next item on the agenda is number 5.
Good morning. This is Amber Long, Asset Management. Staff recommends the approval of the disposition of excess land for the terms discussed in closed session. Are there any questions?
Any questions for Amber at this time? Is there a motion to approve the staff recommendation?
So moved.
Motion is made, seconded, and carries unanimously to approve item number 5. Thank you, Amber.
Thank you.
Commissioner, I'm sorry to interrupt. Scott, you're still muted. Or if you're voting, could you please indicate your vote?
I have voted affirmative on all the votes so far.
Okay. Thank you, sir.
Thank you, council. Next item on the agenda is number 6 in El Paso County.
So Burton, you should be in the meeting now. You should be able to come up to comment.
Well, this is Russell May again. I can help my staff for
You're batting
technical
cleanup, Russell.
problems.
You're batting cleanup here.
I'll fill in for Burton. Russell May with Asset Management. Staff is recommending the approval and disposition of PSF land under the attached terms and exhibits as being presented in the best interest of the state and PSF. Any questions over the disposition of the El Paso?
Any questions from the board at this time? Is there a motion to approve?
So moved.
I'll
Thank you,
second.
Russell.
Motion is made and seconded with one abstention from yours truly, the chairman, to approve item number 6. I've filed a memorandum to that effect for the file. Next item on the agenda is number 7. I believe Mr. Martin will kick that discussion off, or did you want me to, Mr. Martin?
I'm happy to kick it off, Commissioner, and you can jump in. I've provided a history of the releases from the RESPA to the board members for your review and consideration. And I've also supplied you with a spreadsheet for discussion purposes only that shows you a snapshot of what the Investment Advisory Committee originally planned for the year, which was to make $1.5 billion in new commitments. As you know, given the pandemic and the effects of the pandemic, it's been difficult for managers to raise money, difficult to have meetings. A lot of deals that were in the process of getting done are no longer, they're stalled or they're dead. Not a lot of activity. So to make a long story short, we have not made any new commitments so far in 2020, calendar year 2020. As part of that spreadsheet, I also showed you history at the bottom of the capital commitments that the board has made since 2015. These are calendar year numbers. And so you can see on the right side there sort of a history of what the actual commitments have been versus the targets during those years. And then finally, in the middle, I've given you a little synopsis of how we expect to end the year in terms of cash available for either further investment in the fund or for release, either to the available school fund or to the State Board of Education for investment in the permanent school fund. So with that background and setup, Commissioner, I'll kick it to you.
Thank you, Rusty. This is an important task for really everyone at the General Land Office, managing the state's minerals and benefiting and helping to finance public education in our state. As Rusty has pointed out on previous occasions, during the past 5 years, the board has released 6% of the trailing 16-quarter average market value of its investment portfolio, either to the State Board of Education or directly to the available school fund, which is essentially the operational account for the legislature in any given session. Last year in 2019, we then gave an additional $300 million to the available school fund. And today, I'm proud to report, thanks to the work of everybody on this call, both on the panel and who are attendees, we are in a strong and financially sound position, probably arguably the best it's ever been. Given our great returns, I intend to make a motion today to release an additional $300 million to the available school fund, but it's not a decision taken lightly. This money is necessary to help fund the shortfalls in HB3. As we are finding out through conversations with legislative offices, staffers, and other agency heads, there was this assumption, a mistaken assumption, that an additional $600 million would be coming from this agency on top of what we have already released. As Rusty has pointed out, we have already released our 6%, and if we do release an additional 300 million that brings our percentage release to 10%, which is a historic amount, and some would say is almost hazardous. But we feel that it's important to fund this shortfall as a result of the passage of HB3. I also want to make clear to those in the legislature that because of the constitutional amendment that was passed by the voters in the form of HJR 151, which allows this board to release up to 600 million per year to the ASF, that isn't shall language, it's may language. So I don't want this to be viewed as an automatic precedent that this board will release 600 million per year. Based upon Rusty's projections, we will only have, after this release, 865 million projected available to release for the next biennium. We intend to work with the legislature and with other leadership here in the state to make sure that we're working with the State Board of Education. But we have to remind ourselves that we have one beneficiary, and that's the school children of Texas. So assuming no questions or comments from the board at this time, I can go ahead and enter this motion for the record.
Mr. Chairman, may I just add to your motion that this is $300 million to be released in fiscal year 2020.
Correct, in 2020, which would make it 600 in this biennium released to the ASF, or this fiscal year, in addition to 55 million that was released to the State Board of Education.
That is correct.
And our fiscal year, remind me, ends in September 30th?
It begins September 1 and ends August 31.
Okay. And this money was in the LBB budget for this fiscal year, is that correct?
It was, and what is disappointing in various conversations and in looking in the footnotes in the reconciliation statement is that they budgeted it based upon us releasing an additional 300 per year, both in 20 and 21, which is, it's a presumptuous assumption.
And so there is an assumption that we will release 600 in next fiscal year as well.
Well, either us or the State Board of Education, and that's an important segue because, you know, I consider our friends over at the State Board to be our partners, and we need them to step forward. Based upon our last meeting, our joint meeting, they are scheduled to release 3.4% of their trailing 16 fiscal quarters in terms of their release to the ASF. Even just with another 100 basis points, they could easily meet that and match us in 2021 for an additional 300 million.
So this is Scott. We're releasing 10%. They're releasing 3.4%.
Assuming we move forward on the motion and release an additional 300 million today, yes. Another wrinkle to this is that our board, unlike the State Board, can move in the interim. We could decide, you know, next board meeting to release more if we wanted to. In the next biennium, and this is a separate discussion because we'll take that on next month, we can flexibly move during the middle of in the middle of a biennium, unlike the State Board where they essentially have 2 fiscal quarters to begin that preparation in terms of what their next biennial release will look like.
So the 3.4% that they're releasing has already been effectively was decided a year ago or 2 years ago. Correct.
Rusty may have more clarity on the timing of that decision.
That is correct.
So that was summer of 18.
Yes.
Okay.
Sometime in 2018, yes.
But if that was summer of 18, then summer of 2020, they'll be making their next decision on how much to release. Is that correct?
That is correct.
And would that be in next upcoming board meeting?
I would expect so, yes.
And then
I hope they look releasing more money.
Rusty, can I ask you one other question? The 6% on 16 trailing quarters, is that solely based on the value of the private equity portfolio, or does that also include the value of the minerals and leases?
It's only based on the value of the assets, the investment assets plus the uninvested cash.
So the money that is sitting in the, I always forget the acronym, the money that is now being managed by the SBOE, is that in the denominator that's the 10% applied to?
It always has been in the past.
Okay.
And so we intend to keep it in there going forward. Yes.
Got it. Okay.
And just for everybody's situational awareness, there is no statutory cap on this board to release over the 6% figure, whereas the State Board of Education is, it does have that exact cap. So they have the flexibility to go anywhere between 0% and 6%. Theoretically, this body could go, you know, well over 10, though that wouldn't be a prudent measure. And so that's another difference between the board restrictions. Yes, Scott.
We don't have do we have a floor? I know you just said we don't have a cap, but do we have a floor?
There is no floor. This board could decide not to release capital to the State Board of Education or the available school fund and just continue to reinvest proceeds.
And if this is Jeff, just to follow up on what the commissioner said. So the State Board has a 6% cap in the Constitution, Article 7, Section 5. We, the board, adopted several years ago a rule which caps our distributions at 6%. The board is allowed to exceed that, and it would do so today if that's how the board moves forward based on the commissioner's motion. But we do have a rule in place that mirrors the constitutional cap of the SBOE. The difference is that if at the board's sole discretion, it can't exceed that.
And another frame of reference is that UTIMCO, and mistake me if I'm wrong, Rusty, but the UT and the A&M system have an endowment for the benefit of post-secondary education, and the legislature has an automatic requirement of a 3% of their trailing 16 fiscal quarters to be released to the available university fund, the AUF, for the legislature to utilize. I believe there's other restrictions associated with that capital in terms of SG&A and CapEx and so forth, but that is actually a recommendation I made to the legislature last year in this discussion, was just give us a number. That way there's no questions between us and the State Board in terms of how and when to be released both to SBOE and to ASF. But what we have here, though, is a different situation, and that's more of an issue we'll take up next meeting in terms of what the biennium looks like. The immediate issue is that in 2020, we have a shortfall of $300 million, and the legislature is looking for this capital. They budgeted it in the reconciliation statement that we would release it, though none of us testified to this effect. None of us appeared before the legislature making a statement to this effect. None of us had any informal discussions making promises. So I present this motion with hesitance, but only because of the historic nature that we face and that the legislature faces right now. So assuming no further comments, I could enter the motion language for the record and we could take a vote. I move that the school land board release an additional $300 million from the real estate special fund account, also known as the RESPA, to the available school fund for fiscal year 2020. Is there a second?
Second.
All in favor?
Aye.
Aye.
All opposed? Motion is made, seconded, and carries unanimously. I believe it was all four of us in attendance today. Thank you for that, and thank you for the discussion, and more to come on that in our next meeting.
Thank you, Commissioner.
Thank you, and I believe Rusty will present item number 8.
Thank you, Mr. Chairman, members. This is a non-voting item. I'm pleased to present you with the quarterly investment report of the Texplo Permanent School Fund Investment Portfolio for the period October 1 through December 31, 2019. The performance measurement calculations and the statistical data that's presented in the report were prepared by State Street Bank and its Private Edge Group, which are the custodial accounting and performance measurement agents for the portfolio. Briefly, I'll give you an executive summary of sort of market conditions during the period. Fourth quarter GDP increased at an annual rate of 2.1%. The rate for all of 2019 was 2.3%, which was less than 2018. That rate was 2.9%, but it was within the consensus estimate of 2 to 2.5% for the year. Unemployment ended the quarter and the year unchanged at 3.5%. As far as the Fed is concerned, citing a moderation in consumer spending, weakness in the manufacturing sector, and slowing business investment, the Fed lowered its target Fed funds rate range from 1.75% to 2% down to 1.5% to 1.75%, and that was at its October 2019 meeting. Also, they reaffirmed the continuation of their balance sheet normalization program, which they launched in October of 2017. And as you know, that program centers around the reinvestment of principal payments from its holdings in agency debt and agency mortgage-backed securities, and the rolling over at auction of any maturing treasury securities. Also, they agreed that the timing and size of any future adjustments in the target range would depend upon their assessment of what they call realized and expected economic conditions relative to their maximum employment objective and their symmetric 2% inflation objective. Looking at the individual sectors of the market in which we invest, starting with real estate, the core U.S. commercial real estate market, which is measured by the Unlevered NCREIF Property Index, which we refer to as NPI, returned 1.55% for the quarter, ended December 31st, and for the year, its trailing one-year return was a healthy 6.42%. Overall occupancy rates were 94.1% during the quarter, and that was virtually unchanged from 94.3% in the third quarter of the year. And those occupancy levels continue to be near all-time highs in the history of NPI. In addition, cap rates declined very slightly from 4.73% to 4.67%. A small decline, but an important milestone since it breached the historic low that was set in the first quarter of 2019 of 4.69%. Looking at the individual gross total returns for each of those sectors, retail was basically flat at 0.05%. Hotel did a little better, 0.17%. Apartments were up 1.46%, office 1.7%. And industrial, again, a very strong performer at 3.15%, the best performing sector by far. And of course, that's due to a continued strong performance of industrial warehouse space. In the energy markets, oil prices experienced their best year since 2016, with WTI finishing up about 35% for the year. Spot prices averaged about $56.85 a barrel during the quarter, and ended the quarter at $61.14 a barrel, which was a 13% increase from the third quarter ending price of $54.09. That increase was primarily caused by an easing in trade tensions between the U.S. and China, and culminating with the announcement of the first phase of a trade deal between the two countries. Oil prices were also driven higher by the December OPEC Plus decision to increase production cuts by an additional 500,000 barrels per day, which increased the total production cut to 1.2 million barrels per day, which is roughly 1.2% of the total estimated 2019 global oil demand. Those production cuts should help reduce overall global oil supply, but supply currently significantly outweighs demand. And in the absence of unexpected future supply or demand disruptions, analysts expect supply and demand to start approaching parity by late 2020. Subsequent to the end of the year, oil prices increased briefly over 3% after the U.S. targeted Iranian General Qasem Soleimani in a drone strike in early January. However, retaliation fears subsequently subsided and oil prices began moving significantly lower as fears over the new COVID-19 coronavirus pandemic began to crush global oil demand. On the natural gas side, natural gas prices were almost a mirror image of oil prices during the year, finishing down over 35%. Spot prices averaged $239 per million BTUs during the fourth quarter, but ended the period at $209, about 12% below the third quarter ending price. A much warmer than normal winter continued to put downward pressure on gas and compounded the continuing dry gas oversupply problem that's caused by the unrelenting growth in U.S. associated gas production, mostly in the Permian Basin. Shortly following the end of 2019, gas prices slipped below $2 per million BTU, and some analysts expect those prices to be below $2 through the end of the second quarter of 2020. Moving to the performance numbers, if you'll look at page 2, performance measurement summary, I'll start going through those numbers for you. Total net asset value at the end of the year was $4.518 billion. The portfolio represented $4.13 billion of that, or 91%, and cash equivalent investments were $388 million, or roughly 9%. As far as performance is concerned, looking at gross returns without cash for the quarter, the portfolio was down 3.08% versus an increase of 1.15% versus the benchmark. Now, I want to pause for just a second and talk about the benchmark, because I think this is something that, given the volatility in energy prices and the way those markets are moving, it's likely that we're going to see overall returns that are trailing the benchmark by a significant amount. And the reason for that is, if you start on the real estate side, our benchmark is a component benchmark, a composite benchmark, and it has two different components. The components that's used to measure real estate performance is an index, an open fund index that's observable and investable. On the other side, though, with regard to energy and infrastructure, there are no private equity indices that we can use to measure against our portfolio. So we, like many others that are in this particular type of investing, use a combination of a CPI plus a spread. So in our case, we use CPI plus 300 basis points. So you can see there's sort of a downside protection there with the benchmark itself, unless we have significant deflation and negative inflation rates. The benchmark is basically always going to be at least 3%. And that's the way that works. So when we have periods like this, where we have a sector like energy right now, it's very volatile, a lot of downward pressure on prices, and comprises a significant portion of the index of the portfolio, then you're going to see situations where we underperform the benchmark and we'll have negative numbers versus positive numbers on the benchmark itself. So having said that, the real estate sector of the portfolio actually continues to do very well. It was up 2.56% for the quarter. Infrastructure was basically flat. It was down 40 basis points, 0.40%. But energy was down significantly at 9.17%. Looking at the one-year returns, the portfolio returned 4.72 versus 573 on the benchmark, so about 100 basis points below the benchmark. The one-year sector returns, energy was down just under 8%, 7.96%. Infrastructure was up a very healthy 18.34%. Real estate was up 10.48%. So I think you will certainly, with the volatility in energy markets, and the, sort of the uncertainty associated with the effects on energy prices related to the pandemic itself, you're going to continue to see volatility and possibly negative returns. So I think you will see the possibility that we would underperform the benchmark on a quarterly and probably a 1-year basis. Looking at longer term, though, 3, 5, and 10-year returns, that's a much different story. The portfolio continues to significantly outperform the benchmark there. The 3-year average annual return at the end of the year was 10.02% versus 6.1 on the benchmark. 5-year return was 12.3 versus 6.93 on the benchmark. And the 10-year continues to do extremely well with 5.22% versus 9.36 on the benchmark. Moving to page 3, we've got a summary of the investment activity during the quarter. As you can tell, there were 3 new fund investments during the fourth quarter. One of those was in energy and 2 were in infrastructure. And the total commitments were $700 million during that period. There were no new capital commitments during the first quarter of 2020, as I mentioned earlier. Looking at portfolio allocations, which are on page 7 and 8. On a purely invested basis or net asset value basis, the portfolio allocation to real estate at the end of the year was 28% versus a target of 33%. Infrastructure was at 34% versus a target at 32%. And energy was at 38% versus a target at 35%. Of course, these numbers change every day. These allocations change every day, and they will continue to change over time. They should become more aligned with our policy allocation targets as the board makes new capital commitments in the sectors and as more of the existing unfunded capital commitments become funded. From a geographic diversification basis, which is on page 11 and 12, our target for the U.S. is 90% and 10% for international. Right now, portfolio is at 95% U.S. and 5% international. And of course, those will change also as new commitments are made and as new or existing commitments are funded. Looking at our portfolio investment manager exposure, which is on page 13 to 14 of the report, on a purely invested basis, the portfolio was well diversified across a platform of 25 different investment managers. The investment policy statement limits the exposure to any one investment manager to no more than 20% of the total portfolio. At December 31st, the top 5 highest exposures were INCAP Energy at 8.95%. That was followed by USAA Equity Advisors at 8.79%. INCAP Flat Rock Midstream at 8.47%. Macquarie Infrastructure Partners at 7.37%, and Clarion at 5.35%. Co-investment vehicles are grouped by manager and presented separately. The highest grouped co-investment exposure at the end of the year were INCAP Flat Rock Midstream at 7.32%. They were followed by First Reserve at 5.19% and Intervest at 4.34%. That concludes my presentation. I know that was a lot of information. I'm happy to answer any questions, but again, this is a non-voting item, so if you have any questions, please let me know and I'll answer them.
Rusty, I have a question.
Thank you, Rusty. Go ahead.
Is it fair to say that your sponsors tend to mark down faster than they mark up?
Yes, I would say across the portfolio, there's more of a conservative bent in valuation, so more likely to mark down than to mark up. That's fair.
Okay. And given the one final thing, given the volatility of what's been going on in the energy market, when do you think that we will understand what particularly our energy sponsors have revalued the portfolio at that we're invested in? Will that be a June 30th if you were a betting person?
I think that, preliminarily, I think there will be a modest adjustment March 31st, which we should be getting those marks sometime, from State Street sometime in early July. Of course, those March numbers are the ones that I use to do the analysis required for you to use in determining how much or if to release money to ASF or SBOE during the next fiscal biennium. So those March numbers are critical to that process. I think there probably will be some write down or a downward mark on those March numbers, but I think the June numbers will be the ones that really tell the tale as far as determining the extent of the negative market reactions from the pandemic. And we won't have those numbers until sometime in October, probably. There's, as you know, the managers have somewhere between 60 to 90 days to do their evaluations, because since it's all private, it is quite a daunting enterprise each quarter to do that. So
Very familiar with it.
Yeah, as you well know.
Hey, Rusty, just out of curiosity, in one of your exhibits, you lay out our capital commitment history since 2015.
Yes.
And in 2020, we initially targeted 1.5 billion, and then I'm noticing in the column on actual commitments that we don't have a figure. Is that the case? And I think you have mentioned before that managers right now are just not raising capital. How long, I mean, I know this is very difficult to pull out the crystal ball, but what are your viewpoints on managers coming back to market with new fund offerings?
Wow. Is that a loaded question, or is that a loaded question? First of all,
I guess it kind of ties into the discussion we just had, and that is available capital for the next biennium and your projections for the 865.
Sure. Let's address the fact that, our target for 2020, again, we're talking about calendar year here. So we still have a little over 6 months to go in the calendar year. Was $1.5 billion that was set by the Investment Advisory Committee at its strategic meeting in January. We have not made any commitments, and the reason for that is we have been looking at some, but the ones that we have been looking at have either the deals, from a co-investment side, the deals have either gone away because the bid-ask spread between buyers and sellers is just too wide. There's just no agreement at this time. Or the managers themselves have had to pause their process because in order for them to sell a new idea, a new fund, a new investment strategy now, they have to have a well-developed response to not only to this pandemic and how they're going to deal with it, but to any future pandemics. And frankly, it's taking them a little longer than they expected to come up with that. And so what you see is the managers that are in the raise process have done a few things. If they're just starting the process, they've pushed it out. They've deferred sort of their push to this fall. So I think after Labor Day, you will see more of them start to roll out again with this sort of a modified strategy to take into account the pandemic. I think also as far as particularly energy assets and infrastructure, and don't get me wrong, the energy industry is hurting right now, but that also means that there are some tremendous opportunities being created. And we have the capacity through this existing money to commit, to take advantage of that. The problem right now is the deals are just not getting done. At the extremes, the very, very small deals and very, very large deals, there's some activity there, but everything in the middle, which is typically where our managers are operating, people are sitting on their hands. It's going to take time. A lot of these deals in the energy market and in some of the associated infrastructure midstream deals, they're going to have to go through the bankruptcy process, because unless the potential sellers are willing to accept the fact that the value of their assets is less right now than they think it's worth, The only way that they're going to be more realistic about the prices is if they go through bankruptcy and they are forced to liquidate those things at market prices, and that's going to take time. We may see some deal. We may see things thaw out somewhat during the rest of this year, but I really don't know that that's the case. And I'm not talking to any managers that really think that there's going to be a lot of deals getting done, particularly in the energy sector, until the first quarter. Now, when I'm talking about oil and gas primarily, the renewable side is different. Solar and wind are very strong. There are a lot of deals getting done there. There's a lot of activity, particularly in the ERCOT, which has a need for capacity. There are a lot of deals getting done there, and we've already positioned ourselves to take advantage of those opportunities through a commitment that the board made to NCAP Transition Fund, which is a fund focused primarily on renewable generation, but mostly on battery storage solutions too. So again, I can't tell you that we're going to do X amount or bring X amount of commitments to the board during the rest of this year. There are 2 transactions that we are tracking. The total is about $300 million. I think that we will, both of those will push through before the end of the year, but beyond that, I just don't know where we're going to wind up for this year. Does that answer your question?
It does. Thank you for that. Appreciate that.
Absolutely.
Any other questions or comments from the board? Assuming none, and there being no further business before the board, the meeting is hereby adjourned. Thank you, Michael. Thank you, Todd. Thank you, Scott, for joining.
Have a great week. Thank you.
Thank you.
Take care.